Hi guys, Kai Savitsky here again, and today let's try and figure out what actually is an option. The easiest way to describe it is to think of it as an insurance, because in some ways the option is an insurance for your stocks or futures. When you're buying insurance for your car, for example, you agree on some terms like the duration of it, the cases which will be covered by the contract, and so on. The insurance company, on the other hand, will check your input data, will also check things like your and your car's age, your driving experience, the number of accidents you had in the past, and so on. Based on this, they will see how much risk they take with you, how likely they will have to pay you in the future, and based on this data, they will give you the price for the contract. Options are similar. You choose the underlying, what you actually want to cover, whether it is Apple shares or Tesla or crude oil futures or whatever. Options also have expiration dates, so you can choose for how long your option will be valid. And in example with cars, you can choose whether you want to protect your car from traffic accidents, from robbery, and so on. With options, you can only select the strike price and whether you want to protect the downside or the upside. If the underlying stock price will go lower than the selected price, the insurance company will pay you the difference. If the underlying price will not go over the defined strike price during the option contract lifespan, then nothing will actually happen and your option contract will expire worthless. So basically, just like with the insurance, you select what you want to protect, called the underlying security, the time frame for the protection or option's expiration date, and you can select the price which you would like to protect, which is called the strike price. Because one might want to protect his downside or upside, we have two option types, calls and puts. If you buy a call option, you want the underlying to rise over the strike price. For example, if you have a call on Tesla with a strike at 500, you will profit from the stock prices higher than the 500. Put options, on the other hand, protect your downside. If you own 100 shares of Apple, which currently trades at 220, but you are afraid that they might take a dive soon, you can buy a put contract. If you will select a put strike at 220, and by the expiration date the share price will be 215, you will get the difference for all the shares covered by the contract. But it is also important to remember that option contract is just a derivative. The price of an option always declines as time passes. If you purchased a call yesterday, for example, at 10, and the price was unchanged, tomorrow your option will cost less. And when the expiration will come, your contract will expire worthless. Because of it, options are considered way riskier than stocks. With stocks, you can own them for years and nothing will happen to them. But the option contract is just some temporary piece of paper that will be worth something only in a very limited set of conditions. Just like with the regular insurance, the more time until the expiration, the more expensive the contract is. The more risky the underlying, the more expensive the contract will be. So if you have just a couple of days until the expiration and the underlying security is some kind of boring ETF that doesn't move much, and if the strike price is far away from the actual stock price, the option will literally cost just a couple of dollars. This is extremely important to remember because most of the strategies are based on it. Option prices are always declining with time. The textbook's description for an option is a right to buy or sell a stock at a selected price for a limited period of time. Calls will allow you to buy a stock at a given price, while puts will allow you to sell your stock at the selected strike price. I hope the video helps to understand what the options are. Just think of them as an insurance contract where you can select four main things: the option type, whether put or call, the underlying security, the expiration date, and the strike price. For now, we will stop here, but I will cover the other stuff in the future episodes. I hope you're already subscribed to the channel, but if not, please do, and please also like a video. It will help me to understand if somebody watches my videos and will give me some motivation to continue recording them. Let me know if this video helped you to understand what option is and which questions you still have. I will try to cover them in the future videos. Have a good day and see you soon.